Good evening, everyone. Thank you for being here for our Confident Investing, Everything You Need to Know webinar. My name is Sarah Reemsma with the Royal Neighbors Foundation, and the foundation is a 501c3 public charity dedicated to building women's futures through financial education. Our goal is to reach out to women across the country and provide them with the resources they need to help them become more financially secure. We're proud to partner with certified financial planner Laura Lyons Cole to bring you valuable information on how to manage your finances and secure your futures. This is our third out of a series of 4 webinars this year, and if you missed the first 2, you can watch them recorded on our website at royalneighborsfoundation.org. So we encourage you to go out and check out those recordings. If this is your first time joining us online, I want to point out a couple of quick little housekeeping things. You'll notice at the left side of your screen, there is a chat box, and we do have a moderator watching that, and type in any questions that you may have throughout the webinar, and we'll be sure to get to them before the end. We also have some people on the phone, so hello there. And we are going to have some polls for everyone to keep this very interactive and fun. This is your webinar, so I want you all to ask as many questions as you want. If you are in a larger group, sometimes you'll be answering these polls. Don't worry about getting consensus. Either skip them or go ahead and just answer them, assign one person to answer them on their own. So let's go ahead and take a quick poll right now just to get a feeling of how many people are out there watching this as a group. So how many people are you watching this with? Just yourself, 2 or 3, 4 or 5, 6 to 10, or a group of over 10? We have several groups out there we know have signed up for this to watch together, and we appreciate that. Great. Thank you so much. Well, we're going to go ahead and get started. I am proud to introduce our presenter live from New York City, certified financial planner Laura Lyons Cole. Hi, Lauren.
Everybody, thanks for joining us tonight and spending a Tuesday evening talking about a scary topic, investing. I was actually working on an article today about Halloween, so this seems like a pretty fitting topic for me anyway, transitioning away from talking about candy to now investing. Similar risk-reward kind of profiles. Let's see. So, hi everyone. Okay, now I think you can probably see me a little better, and hopefully you can hear me okay. Does investing scare you? There's a question on the side in the checkbox for you guys. But investing is an interesting topic, especially for those of us who are women, because the media and financial advisors have this tendency to try to make it seem scarier and harder than it actually is. And interestingly, as you might have seen in the PowerPoint slide that we just had up, which I'll open again, studies have shown time and time again that women, although we're more likely to report less knowledge about investing, we're actually more likely to be better at it. We make fewer mistakes and we don't repeat them as often. So this whole presentation is about confident investing, and my goal is for you to leave tonight feeling a little bit better and a little bit more confident in your ability to invest for your future. Because at the end of the day, if we're going to achieve our financial goals, investing is a part of that, and it's really not that hard. So I want all of you to feel more confident when we walk away today. Of course, before we get started, I want to ask a question and take a little bit of an assessment to see how we're feeling about investing. So we're going to pop up a poll. There it is. And I just want to know, how confident do you feel when it comes to investing? And we've got answers here. I am completely in the dark. I have learned some things, but I'm still confused. I feel pretty confident, but want to know more. Or I am very confident when it comes to investing. So it looks like we have a pretty broad range, actually. Wow, a really broad range, with just a small little group of people feeling very confident and everyone else feeling somewhere in between. Give you guys another few seconds to get your votes in. Cool, we're pretty evenly spread there. So I'm going to go ahead and close the polling. Thanks for voting on that, you guys. Okay. So wherever you fall on the spectrum, some of you felt completely in the dark, and a few of you felt very confident. Investing really isn't rocket science, and there's a few basic principles that you can use to help you feel more confident, and that's what we're going to go through tonight. Some of you, I think, that I met back in Iowa, actually, we did an Investing 101, so hello to any of you that I saw in person at that workshop. So glad to have you join us tonight. And for those of you who have never learned anything about investing tonight, don't worry, we've got you covered as well. Now, like I said, financial advisors and the media have this tendency to make investing seem scarier than it is. So I want you to start the very first thing, and if it's the only thing you take out of tonight, remember that all of that is really just noise. So you have to learn to tune out the noise and to get down to the basic principles, which is what we're going to cover. The first basic principle is knowing your goals, and we'll go through all of these individually. The second is to get the right mix of investments based on the goals that you've identified. The third is to evaluate costs, and that's one of my favorite things because I love to find things for a good deal, even investments. And the fourth is that quality control matters. Now, before we jump into all of these different things, I do want to just quickly go over a few investing terms so that anyone who is, tuning in doesn't know anything about investing, we can all be on the same page at least. Now, some of these words you might have heard before. I'm going to do my best to explain them. A stock is the most common term that you might hear when it comes to investing, and a stock just means a tiny slice of ownership in a company. So a company like Coca-Cola or Xerox or Apple are actually publicly traded companies, and that means that all of us as Americans and even internationally can own a little tiny piece of that company. And when that company does well, our stock does well. The opposite of that would be something called a bond. And bonds are a little bit confusing to people, but bonds are basically, think of yourself as a bank or as a credit card company, and you can lend money to companies like Apple or Coca-Cola or Xerox. You can actually say, here's $1,000, you can borrow it, but you've got to pay me back with interest. So with a bond, you get your money and you get an interest payment on it, just like the credit card companies get from you if you're carrying a balance. So that's different. That's more like being a lender as opposed to being an owner, which is what the stock is. An index, anyone who watches the news has probably seen the S&P 500 or the Dow Jones talked about on TV. Is it up today? Is it down today? Those are both examples of indexes. Indices, I don't know. Some grammar police out there will probably tell me what the correct plural of that is. But anyway, so an index. An index is basically just a way to measure a certain group of stocks. Now, the S&P 500 is an index that's tracking the 500 largest companies in the United States. So Apple is obviously huge on that. So is ExxonMobil. Coca-Cola is on that as well. It's the 500 largest companies, and it sort of is a measurement of the United States economic health. So in 2008, 2009, when we had big drops in the stock market, there are big drops in the S&P 500, big drops in the biggest 500 companies in the United States. So it all kind of starts to make sense when you can understand it from this perspective. Now, when it comes to investing, some people pick individual stocks. And if you have grandparents or maybe even your parents or maybe your own self, that's a more common way of investing in the past. These days, most people get into the stock market and into investing through using mutual funds. A mutual fund is really it's an investment vehicle, right? So think of it as like a basket of a bunch of different stocks. So you could have a mutual fund that's tracking large companies like the S&P 500, and there's going to be a bunch of different companies. So rather than putting all of your money into one company, you're spreading it out across multiple companies that are sort of similar. Some mutual funds are managed by an individual, and that could be a stock picker who is choosing which companies they think are going to do well in the future. And then other mutual funds are actually measured by a computer program. Those mutual funds are called index funds. And basically, you can buy a mutual fund that tracks the performance of the S&P 500. So when you're watching TV and you see the S&P 500 is up 2 points today, then your mutual fund, your index fund that's tracking the S&P 500 will also be up about that much. So it's a type of mutual fund. It's a more basic computer-generated approach to investing rather than having, some high and mighty person who is making predictions on which stocks they think are going to do well. An ETF, so much buzz about ETFs these days. You've probably heard this word, exchange-traded fund. And it's basically very similar to an index mutual fund, but it trades a little bit differently. So an index fund and all mutual funds trade at the end of the business day. And that's 4 p.m., the end of the trading day. Only once a day. Exchange-traded funds trade periodically throughout the day, and so do stocks. That is really not that important. It's just important to know that an exchange-traded fund is very similar to an index fund. It just trades a little bit differently. They essentially do the exact same thing. And they both have very low fees associated with them, which we'll get to later. Target date funds are another big buzzword, and they're a good buzzword to know because a lot of us have those in our 401k plans at work. And target date funds is another type of mutual fund that just tracks a certain investment time horizon. So if you know that you plan to retire in 2030 or around that time, you can buy a target date fund to have your investments, your mix of stocks and bonds automatically recalibrate based on each year that you get closer to that goal of needing that money. And that's important. We'll get into why that's so. So this is sort of an overview of the important glossary terms that I might say. And if you have questions about these terms, by all means, feel free to ask them at the end or send us an email afterwards. We'll be happy to respond to and clarify anything as we go. Now, the first basic principle of investing is to know your goals. You absolutely cannot start investing until you know what you need to use that money for. So if you've got money that you've set aside to use in the next month, like to pay your rent or your mortgage or your grocery bills, you do not want to invest that money. That money needs to stay somewhere safe, like in a checking account or a savings account. Money that you won't need until further out into the future, like for retirement or for your children's college education, or even money you don't know what you're going to do with, but you don't need to use it for the next 10 years, 5 years, 10 years. That money can be put into the stock market and invested. Anything that you need in the next 5 years or less should not be invested. And the reason for that is that it's simply too risky. Now, when it comes to the stock market, as we all kind of learned in 2008 and 2009, it doesn't always just go straight up like that, right? Our investments in the stock market has a tendency over time, historically, it has increased by about 8% per year, but it doesn't go like this. Sometimes it goes down on its way up. Okay, and that's what happened in 2008, 2009. And if you needed that money at that time, a lot of people lost 40% of their portfolio. So investing is not always safe. There are going to be times where we risk losing money. Granted, in the long run, over time, that money will come back, and a lot of that money has come back and continues to go up. And we believe in the U.S. economy, and we know that over time, we're going to continue to increase the value of our companies. Our companies will do well. Those of us that own stock or mutual funds that own stock will also do well. But there is an element of risk associated with it, which is why it's important to know that you have to invest money that you don't need tomorrow and that you don't need in the next few years. So making sure you have the money you need for your immediate goals, but also for your long-term goals, is essential. And I like, saving for retirement can be kind of hard for those of us who might be younger, or even those of us who are closer to retirement. It's hard to say, you know what, I am going to skip buying those lovely new shoes because I need to put more money into my Roth IRA this year. That's a hard thing to say. But it's easier to think about retirement and saving for retirement if you think about it's just spending in the future. So if you don't buy those shoes today and you save and invest that money instead, then you can buy lovely new shoes in your 70s. It's all about striking a balance. Now, another important thing to note here is that saving for retirement is more important than saving for your child's education. A lot of parents have this guilt of trying to balance, I got to pay for my kids to go to school, but I also need to fund my retirement. I don't know how to prioritize my money. Retirement comes first. Your children can get loans. They can get student loans for college. You cannot get elderly loans for retirement. Okay, so retirement has to come first. It has to be your priority. Make sure you're on track with that first. Sort of like on an airplane, and they say to take your oxygen mask and you got to put it on first before you help children or other people who might be dependent on you. Same thing when it comes to retirement and saving for education. Okay, so saving for retirement, how do you tackle it? Number one, always get your 401k match. You know this, but I guarantee at least one person that's tuning in tonight is not actually taking advantage of your 401k match. If that is you, tomorrow, please go to your HR department and change that. Ask them what percentage you need to contribute and do it, okay? If you're already getting your 401k match, you might want to consider going to HR anyway and telling them you want to increase your contribution by 3% or 5%. You won't even notice, I promise. Okay, 401k match, must do. If you are in your 20s and if you qualify, which takes into account your income, you can learn about that online. Just do a Google search for Roth IRA, qualify. You should be contributing to your Roth IRA. Roth IRAs are really important when you're younger. Everyone in their 20s, this is a really good decision for, okay? And it's a great place for choosing investments. Just like in our 401k, we can choose different investments. The Roth IRA is the same thing. In fact, we have more choices in a Roth IRA. So if you're in your 20s, open a Roth IRA and do your best to max it out or get as close as you can every single year. If you're in your 30s or later, it's very important that you take a serious look at your retirement goals. And you need to know that you're on track to live comfortably and to have financial security when you're older. Now, that might mean working with a financial advisor. That might mean working with online calculators. That might mean just arbitrarily deciding to save 20% of your income or 30% of your income to be extra sure that you're safe. Whatever that is for you, you've got to get serious about your goals by the time you're in your 30s, and you have to make savings a priority. It has to come first before you decide on any sort of spending goals. People love coming up with budgets. You know, I'm going to spend $200 on groceries this month, whatever. That's difficult to stick to. What's absolutely essential to do first is to come up with a savings percentage. If you make that automatic and just get the money going into your 401k, going into your IRA, going into a savings account, then you, out of sight, out of mind, you won't have as much money to spend and you will be preparing for your future. Now in 2013, you can contribute to your 401k and your IRA. And if you can actually do both. It sort of is, it depends on your exact income situation, and there's a different strategy that you can learn to figure out if you do qualify for both, but a lot of people can. So between your 401k and your IRA, you can save up to $23,000 for retirement this year alone. And if you're over 50, you can actually save $29,500. Now, some people listening might be like, that's my entire salary. How can I save that much for retirement? I'm not saying you have to save that much. I'm just saying that the government gives us the ability to save on taxes by contributing up to that limit into our retirement. And if you can hit those kind of numbers, it's really good to get there. And if you can't, you want to just strive and do as much as you possibly can. When it comes to choosing investments, right? So, and you're like, everyone's probably like, we're not even talking about investing. I know about retirement. Stop making me feel guilty. The thing is, when it comes to choosing investments, it's really important to do it in the right account. So for most of us, and I would venture to guess everyone on the call tonight, the best place to invest is in your retirement account. So whether you're in your 20s and it's your Roth IRA, or if it's your 401k at work, or if it's an extra account that if you're self-employed, maybe it's a self-employed SEP IRA, whatever account it is, that's where you really want to start investing. If you're saving money above and beyond that $29,500 retirement limit, then we'll talk about other options. For now, let's just focus on investing within our retirement account. So actually, before I move on, I just want to ask another poll question, and I think that will pop up momentarily. I want to know, how much are you guys contributing to your retirement savings accounts each year? Nothing yet is one of the options. 0 to 5,000 is another option. 5,000 to 10,000 is another option. And as much as I possibly can would be the last option. So if you just want to, okay, good. So this is really helpful to know. For those of you who haven't yet started contributing to your retirement, it's great that you're on this call, because starting to do that is the first step towards becoming a wise and confident investor. For those of you who are, the rest of you who are contributing a lot to your retirement, you probably already know a thing or two about investing. So hopefully I can help you understand even better how to evaluate the choices that you're making. Okay, great. So there are 7 of you that haven't started contributing to retirement yet, and I want to get an email from all of you next week. I'm expecting 7 emails, whoever you were, that said that, saying, Thanks for the advice. Now I'm contributing to retirement. That's your homework. Okay. So now we all know we're going to invest inside of our retirement accounts, right? We're going to contribute as much as we possibly can towards our retirement accounts. Once we've got that money there, let's say it's $10,000 or $100,000 or $500,000, what do we do with it? And that is the basic question about investing, right? And this is where the media gets involved and they have all this noise trying to tell us, here's what you should pick or here's what you should pick, and everything's conflicting and it's so confusing. Well, back to basics, we're going to tune out the noise and focus on the principles, right? Now, the principle number 2 is get the right mix. There's safety in numbers. You've heard that before, and I know as women, we tend to travel in packs, whether it's to the bathroom or walking down the street at night, right? Safety in numbers is a good thing to remember when you're thinking about investments. Now, you don't want to put all your eggs in one basket. So I've heard really terrible stories about people who don't know anything about investing and put all their money into one stock or think, oh, Apple is through the roof right now. I'm going to take all my money and put it into Apple and cross my fingers that it keeps going up and that I become a millionaire. That is not smart investing. And in fact, men are far more likely to take that approach. Women are more cautious and we tend to be a little bit more reserved, which might come from some of our lack of confidence. The best way to start choosing investments is to just take a logical approach. There are things called risk tolerance questionnaires that allow you to figure out exactly how risky you can go with your investments. Now, some investments are very high risk. Other investments are more safe. You've probably heard about blue chip stocks or some of the more classic companies in the U.S. that we don't think are going to go out of business, but also they don't always return the biggest gains for your money. So with investment, the riskier a stock is, or the riskier a mutual fund is, the more opportunity for growth of your money. Before you even start investing, it's really important to know what you're going to be using that money for, because you don't want to, like I said, put all your eggs in one basket and then end up with nothing to show for it at the end of the day. That would be scary. The term to figure this out is actually called diversification. We'll go through that. Diversification is very important. Safety in numbers. Index funds are going to work best for most people, and that's because they're computer-generated investment vehicles, which are just cheaper. So cheaper is better. We'll get to that as well. Target date funds can be a very good option, so I want you to keep that in mind. And you can't stress out about the day-to-day movement in your stocks. So a lot of people love to tune in to CNBC, or they watch just CNN or the evening news, and they want to know if their investments are doing well. When it comes to investing, we can be really emotional and irrational, and if you see that the investments are down a little bit today, it's easy to think, oh my gosh, I'm scared of investing. I want to put all my money back in cash. You have to learn to overcome that. So it's almost better to just not even watch the news, which is something that I like to practice a lot of times, because I would rather read a book or do something to give myself a break from the world. So when it comes to investing, that is a good strategy. Now, you can see on this slide here, this is what's called a risk tolerance questionnaire. This is an example. And I've got the links, and we can send these to you as well, where you can actually access this on your own so that you can take it and get a personalized result for your goals. Now, risk tolerance questionnaires are generally going to be asking questions about how far away your goals are. When will you need this money? Now, you can see this is so easy. It's really accessible to take this quiz, right? The length of time I plan to invest before I begin withdrawals. I'm just reading straight off here. It might be less than 1 year, in which case you shouldn't be investing. We've already covered that. Or it might be more than 15 years. You just slide the little bar, answer correctly based on when you think you will be retiring and when you'll need this money, then move on to the next question. Now, with the investment risk that you take, part of that comes down to how long you're going to need to withdraw this money over time. I was actually reading a study the other day that said a few interesting things. People who are born between September to November are more likely to live to be 100 years old. Now, I was born in September, and I have a great-grandmother who lived to be 102 years old. So I fully expect that I will live to be 100. Another thing was that children who are born to women who are under the age of 25 also live to be 100. more often than the opposite. And my mom was 24 when I was born. So I am totally living to be 100. I have to prepare. I have to make sure that I have enough money saved up so that I can pay all my bills and all my healthcare needs until I'm 100 or 110 or however old I live to be. Now, you need to think about, it's kind of morbid, but you need to think about these things for you as well. Now, think about your family history. If you've got great longevity in your family, that's exciting, but it also means that you need more money to take care of yourself. If your family or if you're already having a degree of illness, you need to set aside more money to take care of healthcare needs. And those are things that are changing. So thinking through what your actual needs are going to be in retirement, besides the casual, like I want to take a cruise a year or things like that. Of course, like we want to do the fun stuff in retirement, but you also need to think realistically about how much money you're actually going to need. So the risk tolerance questionnaire will take that into consideration. For me, I chose that I'm going to need to withdraw that money over more than 15 years, because if I retire at 60, I hope, maybe 70, and then if I'm going to live to be 100, that's like 30 to 40 years of not working and living off my retirement fund. So investing is really how I can reach that goal, and I need to be choosing wisely, which is why we have this risk tolerance questionnaire. Now, the time horizon is one element, but it also matters how well you can stomach risk. When, for those of you who were in Iowa and we talked about Investing 101, I asked the question of the group, and I'll ask it again tonight. It's not a poll question, so I can't actually see your answers. But investing is a little bit like two different swimming options, and I'll present them both to you, and you can think about it. Now, it's sort of a would you rather game. The first option would be that I will give you $1,000 if you're willing to go snorkeling in shark-infested waters. The second option would be that I will give you $100 to go snorkeling with dolphins and beautiful fish and absolutely no sharks whatsoever. Now think about that for a second. How many of you would be likely to take the risk for the $1,000 reward? How many of you would be willing to actually swim with the sharks because you want that extra $1,000? Now, a lot of people, most of the people that in the conference where I asked that question said they would much rather take the safe route, avoid the sharks, and take the lesser amount of money. And this applies to investing as well. So some of us have the stomach to take on greater risks, and some of us feel more comfortable playing it safe and staying out of shark-infested waters. That's important when it comes to investing, and a risk tolerance questionnaire can help you gauge where you fall on that spectrum. Now, you can see the questions here about whether or not you prefer an investment that's going to have great fluctuation in the amount of, gains and losses from year to year versus whether or not you would rather just keep an investment that pretty much stays the same, not a lot of great fluctuation. So this is sort of dependent on your own personal tolerance to deal with the anxiety and ability to tune out the investing noise. Now, there's more questions than just this, and if you click on one of these links to visit the questionnaires on your own, then you'll find out exactly where you fall on the spectrum. For an example, this is the results that when I answered the questions that came up for me. Now, as you can see, there's a mix between 70% of the investments that I choose should be within the Vanguard total, and this is Vanguard, I'm just using Vanguard as an example. Vanguard Total Stock Market Index Fund. That means that we're investing in that money, stocks all across the spectrum. So you've got Apple, you've got big companies like Apple, you've also got little tech companies, companies that we've never even heard of, all kinds of companies. Then in addition to having United States domestic stocks, we also need to have some international stocks. And you can see there that I got a result of 30% of my money should be in international stocks. And those are generally considered more risky than U.S. stocks. And it just depends from year to year. But generally, that is considered a higher risk investment. And these are both index funds. If you're older, your results will probably also include investing in bonds. The key is take the quiz so that you can get your personalized results. Absolutely don't use this as any sort of guideline because everyone is different. That's why these risk tolerance questionnaires are so great, because you can actually get the right answers for your own personal goals. Now, let's see here. Once you've kind of figured out what types of stocks you need to be investing in, whether they're big U.S. companies or international companies, or if you need to have some bonds, all through taking your risk tolerance questionnaire, making it really straightforward and simple. The next thing is to figure out which mutual funds you're actually going to pick to fulfill the different investment needs that you have. And this part can get a little tricky. If you have a 401k, this is a little bit easier because 401ks typically offer 10 mutual funds. And they tend to be pretty good ones, especially if you work for a big company. They'll be pretty good index funds or mutual funds. You'll have a few target date funds in there. It's a lot easier to choose funds within a 401k program. If you need help figuring out what you should be choosing within your 401k, you can usually contact the customer service representative, whether it's Fidelity or, if you don't know, you can go ask your HR department and find out who you can go to ask for help. Or they may have their very own risk tolerance questionnaire that you can take and then click through to purchase whichever mutual funds that they recommend based on your risk profile. If you don't have that, and if we're talking about your IRA or any sort of other investment account where you're actually picking your own index funds or mutual funds or stocks for that matter, the choices can seem limitless. There are like a million different investment options, and it's very hard to sort through them all. But here's the thing, it's actually not that hard. And a lot of what it comes down to is the cost. So, there is no such thing as a free lunch, right? So every investment is going to cost the investor a certain amount of money. And there are lots of different varieties of investments. Let's just talk about mutual funds, for example, right? You can have 100 different mutual funds that try to track the S&P 500. So many different brands, different companies, and there's not a lot of variety, really, between them. And so this is actually an example. I love this example to think about it this way, right? Let's say you need to buy a gray t-shirt for work for some reason, maybe for your softball team at work, or maybe your child needs one for a performance they're doing. You need a gray t-shirt. You have a million different options of where to pick up gray t-shirts, right? So this blows my mind, but some people might choose to, not to sound biased, which clearly I am, but some people might choose to buy a designer gray t-shirt for $85. And that is a choice that it is America and we are free to make. But you can get the same gray t-shirt from, I believe this one's from Old Navy, on sale for $8. I can't even tell a difference between the two of them. I think I actually like the Old Navy one a little bit better. So my point being, a gray t-shirt is a gray t-shirt is a gray t-shirt. And the cost associated with it is really an important factor in making the decision. So in my opinion anyway. So a cheaper t-shirt is better for your bottom line than the more expensive t-shirt, and no one is going to know. Now, I actually was going to ask a poll question, and I think that I might have swayed everyone's vote, but please try to answer honestly based on your preference. Which t-shirt would you choose? Would you choose the designer t-shirt because it's got a designer name attached to it, or would you choose the cheaper t-shirt? And I'll be shocked if anyone chooses a designer t-shirt. I'm sorry for swaying you guys away from that. Though I have a feeling that, one person. I want to make a guess as to who that is. I think I might know. I want to know afterwards. Whoever you are, send me an email. Okay, so yes, most people would buy the cheaper t-shirt. Well, here's the great thing to understand. You can do that with investments too. And I'm actually going to walk you through how to understand how to do it. Okay, so I work one-on-one with clients, and a lot of times those clients will be women, right? And it's so interesting to me when I look at their statements for their IRAs or any sort of investment accounts they may have. And I want to encourage everyone tonight, even though I can't sit down and do it one-on-one with you, I want you to pull out your investment statements and go through this process that I'm about to show you, because way more often than I would like to see, I find women who are overpaying for mutual funds. And that's because there's no education about how to be cost sensitive or price sensitive when choosing investments. Usually we're working with a financial advisor and we trust what they say. And if they tell us this is the fund to buy, then we say, okay, sign me up. I don't know. And I don't even know how to figure out how to know. So sure. The problem is some of those financial advisors are salespeople. Generally not with your 401k, though you still need to be cautious with a 401k plan, but if you have any mutual funds that you've bought through outside parties, not through your employer-sponsored plan, you need to pull out those statements and check out to make sure that you're not being overcharged for what you're getting. So let me just show you an example. Okay, this is a lot of information. I'm going to try my best to walk you through this in real time, actually. But, you know, Google is a great search tool for everything, including comparing mutual funds. You may not have known this, but you can actually learn a great deal of information about the mutual funds that are available to you through your 401k or that people might try to sell to you just by going to google.com/finance. Now, I'm going to try this. I've never done this before. I'm going to try to share my screen with you so that I can do this with you in real time. So I'm hoping that someone will send me a text message if this doesn't work correctly. But it looks like it is. Okay, it looks like you can see my screen. I'm really not sure what you can see, but I hope you can see google.com/finance. Now, all I've done here is I've just pulled up one of the mutual funds that was recommended to me through the Vanguard's risk tolerance questionnaire that we did before. That was called the Vanguard Total Stock Market Index Fund Investor Shares. The way that you can get this to come up is just to simply go to google.com/finance. In fact, I will do it from the beginning. And okay, so here I am, google.com/finance. Oh, there are my poll questions for you guys. Okay, google.com/finance. Now, I'm just going to type in the name of the mutual fund. See, you can see it starts coming up with the different funds that are available. So every fund you've ever heard of, Google has heard of it too, okay? So Vanguard Total, sorry if you can hear me typing, stock market. See, and you'll see that there's a bunch of different ones. So you can just keep typing until you get to the correct one for what it is that you're looking at. Now, in our case, it was actually this one, and I know that, so I'm just going to pull it up. And here you go, a lot of crazy information. But guess what? It's actually really easy to make sense of all of this. And this is the best thing that you can take away from tonight. And no, I don't understand why people don't teach this more often. To me, this is the key to understanding and feeling confident when it comes to investing. Now, this is a mutual fund that Vanguard has told me that I need. So, okay, I'm going to look at it. The overall Morningstar rating is really important information because this is a third-party outside source that is evaluating this mutual fund. So it's not a salesperson. It's not, you know, there's nothing biased about this rating. It's a really complicated algorithm that they use to evaluate various mutual funds. Now, this one is a 4 out of 5 star. That is excellent. You don't ever really want to pick something that's a 2-star or less. 3-star can be fine. 4-star is better. And 5-star, I've almost never seen a 5-star fund, so don't expect to see that. Now, that's the first thing you're going to look at when you're looking at a mutual fund. Now, if you have those statements for accounts that you own, you can find the names of the mutual funds that you own, and you can pull them up here, doing the exact same thing that I'm doing right now. I'm just going to go back to my screen to make sure no one's, okay, looks like it's working. So now that we're looking at the screen, we've seen this, everything else that you see here, all this jumbly gook kind of stuff. You're just going to let your eyes relax, skim over it. Don't look at it closely. It doesn't matter. It will just confuse you. Scroll down, scroll down, scroll down. Ignore this. This is all, it doesn't matter. Well, it matters, but you don't need to know much about this. Now, the Morningstar statistics are detailed a little bit more down at the bottom if you scroll down a little bit. So now you can see, okay, this has been this fund has gotten a good solid 4-star review for over 10 years. Okay, so now I'm feeling a little bit more confident about the quality of this mutual fund. I'm going to scroll down just a little bit more and look for this part, key statistics. Within the key statistics is where you can learn about some of the important numbers associated with your mutual fund, right? So here you can see, this doesn't really matter, total assets, great. There's billions of dollars invested in it. So some people seem to agree that this is a good fund. These words here, front load and deferred load, are really important. Sorry, okay. Front load and deferred load are really important. Now, load is finance speak for commission. Don't ask me why it doesn't just say commission there, but for whatever reason, they use the terms front load and deferred load. If there's a dash here, that means there is no commission associated with this mutual fund. If there's not a dash here, you might see a percentage. That is the percentage commission that the financial advisor gets for selling that fund to you. And I'm going to show you an example where you can see that in a moment. Now, the expense ratio, like I said, there's no such thing as a free lunch. Every single investment fund is going to have an expense ratio associated with it. What you want to look for is an expense ratio that is less than 1%. So here you can see it's 0.17%. That's totally excellent, really good. Everything about this mutual fund is coming up roses for me. I'm thinking, okay, you know what? This is a good fund. Now, just to show you an example, another fund, and I'm kind of just making this up as I go along, but another really popular fund that in fact some of you on the call tonight may very well own is called the American Funds Growth Fund of America. So I'm going to click on that one. And you can see same information comes up. It's just specific to this particular fund. And here we've got an overall Morningstar rating of 3 out of 5 stars. Again, that's okay. You know, we'd rather have something that's 4 stars, but 3 stars right away isn't going to make me necessarily write it off. And I just looked and saw that I haven't lost anyone during this process too. I hope you guys are engaged because this is like high-tech stuff we're doing right now. But thank you for staying tuned. Okay, so overall Morningstar rating of this American Funds, the Growth Fund of America, 3 out of 5. Okay, we're going to scroll down, ignoring all of the stuff, and get to the Morningstar statistics again. Here you can see at times this has been a 4-star fund, and in more recent years, basically since the financial meltdown, it's only been a 2-star fund. So it's averaging out to a 3-star fund, but really it's kind of a 2-star fund right now. So that's important to be aware of. And we're going to scroll down just a little bit more, and you'll see here, under key statistics, this is a fund that has a commission. 5.75%. So if you bought this fund, you actually paid almost 6% of your money to the financial advisor you were working with as a commission. That's something that I just don't feel good about. And I find that that happens more often with my female clients than with my male clients, and that makes me very angry. So I like to bring your awareness to this because it's really simple. Before you say yes to anything when you're working with a financial advisor, take the time to look for yourself and figure out what the costs are associated with what they're trying to sell you. Make sure that you're not paying a commission because in that case, the financial advisor isn't completely unbiased. They're somewhat not working in your best interest. They still might think this is a good mutual fund, but like we've seen here, it's only been a 2-star mutual fund over the past few years. So if that person earned a commission to sell you a not so great fund, that's kind of a bummer. The expense ratio here is okay. It's under 1%, 0.71% is not bad. Let's see. I still haven't lost anyone. So as long as you guys are paying attention, I'm going to show you one more example. Let's see if I can get a good one here actually that I want to show you a negative mutual fund. So let's see here. Oh, let's look at this one. This is Templeton Growth Fund Class A. So this is going to be exactly the same as the American Fund. So the Templeton is like a different version of the gray t-shirt, right? We're looking at 2 gray t-shirts here. These are both growth mutual funds. The Templeton Fund is only a 2-star Morningstar. Okay, so right away, if you own this in your portfolio, you don't really want to, okay? It's not a good enough fund because essentially the Vanguard one we were looking at is very similar to this and was a 4-star fund. So you'd be better off choosing that one over this one. Again, I'm really giving you this information is more to be able to evaluate and have an educated conversation with your financial advisor. I don't necessarily think that you guys are going to be able to go out and choose specific mutual funds based on this information, but you can evaluate what's available to you in your 401k and also what's presented to you from financial advisors. So this just gives you the opportunity to have a more educated conversation with these people and to ask the right questions, basically. I'm just scrolling down. Looking at the Morningstar statistics again, it's actually been doing a little bit better in recent years, but still overall not a strong fund, not one of the, shining superstars in its category. And again, front load, so you're paying a commission of 5.75% and the expense ratio is over 1%. So not only is this a less good fund, it's also more expensive. which could, I mean, if anyone ever has bought a designer t-shirt or designer clothes, sometimes, or really nice undergarments, sometimes this happens where you pay a lot more money thinking it's better quality, and in the end it ends up unraveling or getting a tear in it or something really disappointing. So more expensive does not always mean higher quality. And here you can easily see that. Now, the interesting thing is, this right here actually means that there's over $16 billion invested in this mutual fund. That's a lot of people who have paid commissions and who are overpaying for a not so good fund. Okay, I'm going to stop the screen sharing now, and hopefully I didn't lose anyone. So, okay, hopefully that was making sense to you guys. And definitely if you're having questions about it, it's something that you can send us an email, we can clarify. If you work with a financial advisor, or if you work with Fidelity on your 401k or wherever your 401k is, don't be afraid to take this information and go to the person you're working with and say, can you explain this to me? I want to understand what fees I'm paying, or I want to understand the Morningstar rating of this. And the financial advisor will know exactly what you're talking about, or the customer service representative, and they'll help walk you through it. So don't be afraid to use this information to have more educated conversations about which investments you're choosing. Again, remember, we've gone through identifying our goals. We've made sure that we were getting the right mix. We're evaluating the cost, taking the risk tolerance questionnaire. All of these steps are just part of the process as we're getting closer to feeling more confident with investing. There's no need to feel like you're the next Warren Buffett, because very few people are excellent investors. You know, whatever it is that those of you who have tuned in tonight, whatever it is that you do that you're very good at, if you're a very good cook or a very good marketing professional, or if you're very good at writing or teaching or whatever you're very good at, there are people who are very good at the job of investing. But for the rest of us, the regular Americans, we can't compete with those people. It's not our job. I'm a certified financial planner. It's not even my job. So there are very few people like Warren Buffett who are excellent investors. And for the rest of us, we just need to feel confident, understanding that we're not getting a bad deal, that we're not paying too much for a fund that isn't good enough. Okay, so that is the main thing to take away from this kind of information. Which brings us to the last principle, which is quality control matters. No one cares more about your money than you do. So even if you are working with an advisor, and even if you like that advisor, it's so important to remember it's your money. You're the one who, if you're like me, is going to live to be 100 years old and is going to be paying bills out of that money in the future. It is so important that you take the time, like you're doing tonight, to learn a little bit more and to demystify these kind of scary topics, like talking about the Halloween connection, so that when it comes time to dealing with your money, you're not ignoring it. I mean, I know it's kind of not the most fun thing to talk about, but you guys seem to be relatively engaged, and hopefully that's true. So it's not that bad either, you know, and that's what I want everyone to walk away feeling, and especially as women, to know that women tend to be very good investors. We tend to statistically do better than men. Take that knowledge to heart and don't second guess yourself. Another thing I like to tell women is that we tend to have a pretty good intuition, right? So you can use that when it comes to making decisions about your money. Not completely, but don't tune it out. You need to be able to listen to your inner voice. So if you sit down with a new advisor and you're thinking that you might give that advisor your money and have them help you save for retirement and invest your money, make sure that you're getting a good feeling about that person and that you feel like they listen to you. You know, it's like a doctor. Like I don't like going to doctors as it is, but if the doctor really listens to me and takes me seriously and answers my questions, and I feel more comfortable and I feel more confident. It's the same thing when it comes to financial advisors or dealing with your money. Now, I would recommend, if you want to learn more after tonight, and there's an endless amount of information you can learn when it comes to money and when it comes to investing, the place that I would start personally would be to pick up these two books. The Millionaire Next Door is my absolute favorite personal finance book. It's excellent, written by two academics who did this huge study researching the behaviors of millionaires and what they do that might be different than some of us. And some of the answers might surprise you. So I would definitely pick up that book. And then The Intelligent Investor. It's basically a classic as far as if you're just starting to try to understand investing, and if you really want to dive in and know more about the principles, this is a good overview and a good place to start. You might, learn more from there, but those two books are definitely good, homework to pick up. And then if you decide to work with a financial advisor, I would also recommend looking for someone who is a certified financial planner. All that means is a designation that indicates that that financial advisor has had to, you have to have certain levels of experience, certain levels of education. You have to pass an exam that's very difficult. It takes 2 days. You have to sit there. 50% of people fail. So if the person has earned a CFP designation, you know that they are higher quality, and also that they have to meet certain fiduciary, which just basically means acting in their client's best interest standards. Okay, so certified financial planner is kind of the bare minimum you want to look for when working with a financial advisor. And if you are one of those 7 people who have not yet started saving for retirement, and if you're in your 20s or even if you're older, and if you don't have a 401k at work, I would recommend opening a Roth IRA, as I said, or possibly just a regular IRA. And where I actually keep my investments is with a company called Vanguard. I find that their customer service representatives are very helpful. They will spend plenty of time with you on the phone. So if this is all new to you and you're like, I think I might want an IRA, but I'm not really sure, just call their toll-free number. You can talk to the people. They're very knowledgeable. They're not financial advisors. They're just there to kind of answer your questions and help you navigate the process, but I find them to be very nice and very helpful. So Vanguard has my stamp of approval. And then whatever your 401k plan is, those customer service representatives are probably pretty great as well and good to take advantage of. But again, quality control matters. No one cares more about your money than you do. Take control. Don't ignore your investments. Continue to learn more. Let this be a jumping off point for becoming more and more confident when it comes to investing for the long run. So that is all we have for tonight. That was a lot of information. I'm so impressed that you guys hung in there all the way to the end. Thank you for letting me kind of get off and show so many examples on Google Finance, because it's really my favorite thing to educate people about. So I hope you found it helpful. Please make sure to complete our survey so that we know if you did or didn't. If you have any sort of extra feedback for us, we're happy to hear it. And if you have any specific questions, please get in touch with us. The Royal Neighbors Foundation has fantastic articles and calculators available on their website. So if you're trying to, plan out how much money do you need for retirement, that's a great place to start as well. So thank you so much, everyone. And I see Sarah's back on. She'll probably mention, I'll quickly mention that we will have another one of these webinars on December 3rd. We're going to be talking about setting financial goals for 2014. So very exciting and fun topic. Please join us and tell your friends to join us for that one as well.
Great. Thank you so much, Lauren. And that's all the time we have tonight. And just another reminder, there will be a survey that pops up, and we ask that you go ahead and complete that. And watch for an email to encourage you to register for the December webinar. And we will also send you all an email with a link to this recorded webinar as well, in case you had any issues logging in or missed anything or just needed a review. And want to thank you all for joining us tonight. Thank you.
Thanks, everybody.
Thanks, Lauren.